Now, shall we get to Meta here? That company out also. First quarter earnings per share beating by a pretty wide margin here at 643 versus the 525 that was estimated. The company coming out with a forecast for second quarter revenue of $42.5 to $45.5 billion. Analysts have been looking for just over $44 billion in revenue. And the company says for the full year, it looks like it is changing its expense forecast. So this is not necessarily its Capex, but I guess its Capex is included in this. So total expenses this year, $113 to $118 billion. It had been $114 to $119. So it is bringing down its total expense forecast for the full year, but just by, not by a huge margin at this point.
Yeah, it'd be very interesting to see how they talk on the call just more about the broader online ad market and environment, just because obviously the extent that you would see any kind of economic slowdown here, Julie, or maybe even a recession, I mean, what would that mean for the advertising market and for Meta in particular? Capex, I mean, analysts didn't think we would see much of a pullback there, just given the importance we know the company is placing on AI. Tariffs and trade tensions with China, there is some concern on the street about China-based advertisers and actually whether they may pull back. But listen, right now, at least initially, that stock's popping in the after hours.
Yeah, and just to give a few other numbers here that we got, I know Dan Howley was looking for Reality Labs just to see how much money it lost, and it did lose $4.2 billion. It's a little bit smaller than the loss that analysts were anticipating. Revenue for Reality Labs coming in at $412 million. The estimate was for $496 million. Now, obviously, that's a relatively small part of Meta, but it's a part that Meta has put a lot of energy and effort into. So that's something to keep in mind. The family of apps revenue, which is the vast majority of its business, at just under $42 billion, $41.9 billion for Meta here. And I'm seeing the Capex guide specifically here, $64 to $72 billion, which is actually an increase here. So expenses overall going down a little bit, but Capex estimate is going higher, $64 to $72 billion. You were talking about what was going on with that. So interesting to see a little bit of an increase.
Yep.
Yeah,
not surprising.
Meta reporting a beat on revenue for the first quarter. The company also increasing its full-year capital expenditures outlook. Scott Devitt, Wedbush Securities Managing Director, joining us now to discuss. Scott, it's good to see you. I want to start with just the overall numbers here and the forecast for second quarter revenue of as much as $45.5 billion. We just heard from Meta's much smaller cousin Snap about this time yesterday, and it seemed like they were having some ad sales difficulties and foreseeing potentially more. Are we seeing any evidence of that of Meta? It doesn't seem to be showing up in these numbers.
Well, I think Snap has a scale issue in terms of its ad platform, so it's a totally different conversation. But at the aggregate level, the advertising industry is holding up quite well. As you mentioned, Meta beat top line, beat profitability by even more. I think relative to consensus, it was a 14% beat in profitability. It bracketed the consensus for 2Q, despite fears that Chinese e-commerce companies like Temu are potentially going to spend less on the platform because of the removal of the de minimis exemption that's pending. Meta doesn't seem concerned about that. And then, as you mentioned, Capex going up, which shows confidence in the business for the full year. And I would also note that the company lowered its OpEx guide for the full year by $1 million as well. So another moderate positive on a net basis. So this is an extremely positive report, especially in the face of that kind of glowing concern of the China e-commerce pushback. The final point that I'll make is that, it's interesting because last quarter when companies reported, the dollar had just completed a period where it strengthened by 4 percentage points. And this quarter into the guides, the dollar had depreciated. So it's a nice offset to this uncertainty of tariffs to be able to guide into that kind of favorable light, especially with Meta having 60% of the revenue coming from outside the US.
Scott, I'm curious, separately, this very high-profile fight the company finds itself in with the FTC in Washington. I'd imagine, your clients must be asking you about that, Scott. What are you telling them?
Well, there's no so Meta has an issue, Alphabet has an issue, everybody has an issue. That's a large company these days with the government. But I continue to believe that the backdrop with this administration is more favorable than the prior administration. It hasn't quite played out yet, but I think as these issues come to resolution, that we're going to find that the administration itself has a preferential view of U.S. technology companies, and also, nobody in government really wants to disadvantage these U.S. mega caps relative to their Chinese peers. So I'm anticipating an outcome that is essentially a slap on the wrist type of outcome, and not something that meaningfully impacts the trajectory of Meta, and that goes for the other players as well.
One of the surprises we've been talking about in the Meta numbers as well is the idea that it raised its Capex forecast for the full year to $64 to $72 billion. That, again, was a bit of a surprise here. What do you think is driving that, and what do you think gives Meta the comfort to be able to do that?
So there's two topics here. One is, as you described it, the comfort. So that means the company has confidence in the strength of the business and is comfortable continuing to spend. So that's a positive. The other thing is that investors are distinguishing between companies that are spending Capex from an offensive standpoint versus defensive standpoint, because some look at what Alphabet's doing and think that's more defensive to keep up with the risks related to AI and its search business, and investors tend to look at Meta's increases in Capex as being favorable because they're well positioned in terms of AI. I don't know that that's the right answer or not, but that's the way investors tend to look at it. And so this raise from a Capex standpoint, it comforts investors in both of those areas in terms of the aggressiveness of the management team to be front-footed spending, and also in terms of the comfort that they can attain their revenue expectations for 2025.
Scott, some of your colleagues on the street, I know, they're very excited, Scott, about Llama. This is Meta's open source large language model. I'm curious whether you share in that excitement.
Maybe a little less enthused than some others. There's a lot of models out there, and I've heard more favorable feedback from some of the competitor platforms, but we'll have to. It's early days, and open source particularly is super early. So I think Meta will be well positioned, whether its LLM leads or its LLM is used to add intelligence to its own platform. Either way, I think the company can win. But Llama itself, I think there's a few others that have an early advantage.
What do you think about the decision of the company to sort of offer it as a separate app? Do you think that's going to be, because now people use it, but it's not like they're opting in, right? It's just sort of built into the product. So now that it does, I guess they're doing both. It's not or, but do you think there will be that significant sort of opting in and usage of that separate app?
I think that companies like Meta and like Alphabet that have massive global scale, effectively every internet user uses the product already, is benefited by bundling the services into the core. And so I would anticipate, whether there is an individual separate offering over time that stands on its own, the vast majority of usage and success or failure of it is going to be based on how it's integrated into the core platform. And that's unique for their business relative to the startups that have nothing to leverage, but are gaining traction because the products are so good. But it's just the way, strategically, that it makes the most sense for a company like Meta.
Scott, good to see you. Thanks so much.
That's right. Let's start things off with Meta. They kind of had the more interesting of the two stories. They beat on both the top and bottom line, but more importantly, they offered better guidance than initially anticipated. They say that Q2 revenue will come in between $42.5 billion and $45.5 billion. The street was looking for $44 billion. And so this kind of assuages some of the concerns for now that there's any kind of advertising slowdown coming as a result of the tariff uncertainty and broader economic uncertainty. Again, they beat for the quarter. They had EPS of $6.43. Expectations were for $5.25, and revenue came in at $42.3 billion versus $41.3 billion anticipated. And I just want to point out, they also raised their full year Capex estimates. They went from 60 billion, between 60 and 65 billion to 64 billion to 72 billion. So a big jump there, and that's obviously related to all of the AI spending that they're going into. By the by, Meta Reality Labs segment had an operating loss of $4.21 billion for the quarter. So obviously not doing the best there. But let's switch over to Microsoft. They also beat on the top and bottom line. They saw cloud revenue of $42.4 billion. That was up 20%. One of the important things to point out here is that AI contributed 16 points of growth to Azure revenue. Now, Wall Street was expecting 15.6 points, and basically Microsoft was saying that that's a result of getting more capacity online. They've been repeatedly saying that they're capacity constrained, it's causing headwinds, it's why their AI isn't as growing as fast as they would like, but now they're starting to get that online, and they're starting to be able to meet the demand that's already there that they hadn't been able to meet before. One of the other things I want to just quickly point out is on the personal computing side, and that's the PC business. They saw revenue of $13.4 billion. Wall Street thought it would come in at $12.6 billion, and part of the reason is that Windows OEM partners, they brought in more sales into the current quarter, just as kind of building up the inventory, because they said that inventory already was elevated and it remains so. So it's an idea of that pull forward of PC sales or PC shipments, just trying to get ahead of any kind of tariff uncertainty in the prior quarter.
We earlier talked to Brent Thill of Jefferies, and he said something that kind of stuck with me, which he said, these are two desert island companies. In other words, if you're a chief information officer at a company or if you're an advertiser, the last thing that you will cut is your check you write to Microsoft, or the money you send to Microsoft every month, and if you're an advertiser, what you spend on Meta. So that even if you do get sort of economic deterioration because of the tariffs or for whatever other reason, maybe they'll cut spending, these companies, eventually, but that it would be sort of a last stand or last straw or last resort that they would take.
Yeah, I mean, look, Microsoft, you obviously need to be in the cloud to play with anything when it comes to the enterprise now. And then when it comes to advertising, yeah, it's Meta, Facebook, whatever you want to call it, and Google. And, we did see declines, obviously, during COVID, but that was super extreme time. So that's all back now. And yeah, I mean, it does appear that they're weathering whatever kind of storm is coming or isn't coming or, nothing.
And then tomorrow, Amazon and Apple. We can do it all again.
Yeah, and then I'll just take a nap for a month.
Yeah,
Thank you, Dan. Appreciate it.
And Brent, I want to turn briefly to Meta here as well, because it is striking that this company is raising its Capex spending plans for this year, as the numbers seem to also largely be ahead of estimates. What does that tell you?
It's a contrast to what Snap said, and I think it suggests, again, the larger ad platforms are going to be in a better position. They had really good numbers across the board. As you mentioned in your lead-in segment, what's interesting is they raised Capex. Everyone thought they would cut Capex. They actually raised Capex from 60 to 65 billion to 64 to 72. So I think it's giving. Zuck would only do that if he sees a return. And everyone says, well, Brent, these are like railroad companies. They're spending so much money in AI. Like, how on earth are we going to see the returns? You're seeing it in 16% revenue growth, earnings numbers that were $1.20 higher, and they've done a really nice job executing. And all of our ad checks lead back to somewhat similar to what I said about if a CIO had to go to a deserted island, they would bring one vendor. They'd probably bring Microsoft. If an advertiser had to go to a deserted island, you only get one vendor to pick. You'd pick Meta because of the breadth of their offering, the quality, the return, the opportunity in wearable AI, the opportunity to improve the searchability of Instagram. You go through. There's so many different drivers. In Llama, we've said this repeatedly. Llama is such a hidden secret, and I don't think I think most investors know about it. But we think Llama is basically a red hat inside of Meta, where you have a free call option on upside in the stock if they can figure out how to monetize Llama, which is their LLM, and everyone in open source is going to them. They're not going to just DeepSeek. It's a Llama and DeepSeek world, probably even more of a Llama than DeepSeek. But those are the two open source platforms. Closed source, you're going to obviously OpenAI and others. But they have a huge opportunity with Llama. And so I think there are multiple drivers still at Meta that are really exciting. And the fact that they're raising Capex is, to me, a great signal that their investments already are paying off.
Yeah, and a surprise, as you said. All right, Brent, we'll let you dive back into the numbers to get ready for the calls. Thank you so much for spending some time with us.